So if the currencies move down or the bond market comes under stress or interest rates move up, it affects their solvency. And the formulas that they use to determine the solvency risk are really based on the assumption that cash will never go away.
And I think from obviously being very much focused on the gold side of things and gold and silver side of things, of course, a couple of things really sprung to mind when I was listening to this and looking at this, is of course that aspect. And you say it's these same four banks who are involved in trillions of dollars of basically of cross derivative structures, over-the-counter structures, and with huge counterparty risk associated with them. And I think, as you kind of rightly point out, that is based on these derivatives historically have been evolved to be based on a stable currency. And now we see fiat currencies imploding. And I think that really got my attention, and then with a particular focus on the precious metal side of things. So, and you went over that in your report quite, very, very well. So what do you see? And obviously, one of the points you made, which was a very important point, is while they have, because of the global problems, because of the really just trying to balance what is a very difficult situation, an imploding financial system. What they've done is waived Basel III requirements for every asset class virtually, except gold. Can you go through that for us, please?
Yeah, so I'll try to distill it down into simple concepts. I wanted to preface the discussion with saying it's highly complex, and really, please go back and read the documents or view our presentation, to understand it. But a simple concept is about 2/3 of the $200 trillion derivative complex are backed up with cash as collateral. And so if any of the fiat currencies experiences issues, essentially what it does is it directly affects the solvency risk of the banking system, especially the four largest banks, which are JP Morgan, Citibank, Goldman Sachs, and what is the other? Citigroup, Goldman Sachs, JP Morgan, and I'm blanking on the last one. In any case, so what happens is where we have all the fiat currencies racing to the bottom, Andrew, and you're familiar with this concept, they're all debasing. The major assumption that cash, $1 today is worth $1 tomorrow, that's in these formulas for solvency risk is not really recognized. And so what happens is what the banks have essentially done is they've taken all the risk of their system and they've used it as collateral for these derivatives. So if the currencies move down or the bond market comes under stress or interest rates move up, it affects their solvency. And the formulas that they use to determine the solvency risk are really based on the assumption that cash will never go away. And we know, throughout history, Andrew, that's really not the case. And specifically as it relates to the precious metals, what happened in 2022 as a result of all these regulations written years ago was they had to formally recognize the risk in the precious metal sector with these derivative positions for the first time. And so there's a chart we showed in which in 2022, the notional amount of precious metals derivatives was much higher than ever had been previously reported. So effectively that had been hiding all this risky derivative exposure the banks had. Now, a lot of us have, over the years, Andrew, gone over the COMEX data and pointed this out, the four largest banks and who they are, and that they have all this precious metals derivative risk, and further, that they're using these derivatives to manipulate the market for precious metals. But to see it in an Office of the Comptroller currency report from the U.S. government put so plainly, I think will surprise a lot of people. And so two main takeaways. A lot of their assumptions are, I think, were put in place with hubris and arrogance as to the stability of the system. The stability of the banks is dependent upon the stability of the dollar and the other currencies in the bond market. And we know right now that those aren't the most stable areas of the economy for reasons we talk about all the time. And further, the amount of exposure they had to insolvency or going out of business because of their precious metals exposure had been understated throughout history until this year, when the BIS said, no, we need you to actually start to pull that out and to focus on it as its own risk factor. They had hidden it in the currency exchange risk, but precious metals and currency aren't the same thing. The precious metals and the fiat currencies, Andrew, we know aren't the same thing. So now for the first time, we have the picture of really how much risk these banks have, but not only how much risk they have to the precious metals if the prices were to rise, but also the fact that they use these derivatives to set the market, and it's just for banks. And that's always been considered conspiracy theory among detractors who say, yeah, that's not true, you guys are making that up, it's not how it works. But again, it's in the office of the comptroller of the currencies report, and they name these banks and they show you their positions. It's really interesting to be able to confirm what we've always known by going through this information.
So one of the benefits, obviously from a gold perspective, NSFR standards really have been very helpful, and we'll talk about that in a minute. But I think one of the benefits then is, although they've waived a lot of the NSFR requirements for general derivatives other than gold, what it's caused is them to report what was previously hidden. Because when you looked at that, when you showed that chart, and we're talking, I mean, and we're going to provide a link to this, because when people look at it, it's mind-boggling, and you just see what was hidden is now disclosed. That's what we're saying, really, isn't it?
Yeah, I think Basel, because of the Lehman meltdown, in a nutshell, they realized that the banking system, to stay stable, we had to have better measures of risk, and we had to address the solvency risk by having better collateralized assets. In other words, have enough good stuff on the balance sheet that if the mortgage market blows up again, it doesn't take down the banking system, in a nutshell. But what that required them to do to keep the banking system going was to shed a lot more light as to what these people are actually investing in and how they use it to move and manipulate the markets. And when I say manipulation, I don't say that meaning there's necessarily a nefarious goal to hurt a certain group of people. I just mean whenever you're in a big derivative market and you've got trillions of dollars going into it, you therefore are setting the market. You're manipulating that price back and forth. And so it almost doesn't matter what your position is in the market. If the market moves against you, that's a risk. So they could be net short and the market goes long, that's a risk. They could be net long and the market goes, short, that's a risk. And that's really what I wanted to point out. For the first time, we see how fragile that system is. And we see it's not built on a strong foundation. It's built on a foundation of sand with a lot of assumptions that are spurious or not well thought out or not well documented. And not only that, but they use those derivative positions to set markets. And not only the precious metals market, but all the markets, Andrew, the real estate market, the prices for securities and real estate, the prices for equities, the prices for bonds, all of that stuff is done and is managed through the derivative market. And we now see with these tighter standards how thin the banks are from a solvency perspective, how much risk that they actually have. And now, like as you pointed out, we can enumerate specifically how the precious metals place into that, where it's very difficult to do that before.
Yeah.